thank you for joining us. We're so grateful you're all able to take time out of your day and join us, and we're so happy to be hosting this program. A little about today's speaker, Paul King, CEO of King Wealth Planning and LPL Registered Principal. Paul will be taking you through the first half of 2020 and powering you through the first half of 2021. Before I hand the mic over to Paul, I have a few housekeeping items to cover. First, today's session is being recorded and will be available through the King Wealth Planning website. We've also added a handout which you can find in the attachments area in the toolbar, which is located to the right of your screen. Next, we'd love to hear from you during today's presentation. Due to compliance regulations, chat features are disabled. If you have a question for Paul, please feel free to send it through email to me at shannon@kingwealth.com, and we will address the questions at the end of the session. Finally, I'd like to kick things off by welcoming our speaker. Paul, welcome. Over to you.
Thanks, Shannon, and wish I could see you all in person, but then it seems like I've been saying that for a year now. So I'll do my best to get through a lot of information, a lot of charts, but I'm going to try to point out, the synopsis of each slide, not that you need to know all the statistics behind it. But of course, last year was a rather compelling year. And really, before I get started, I wanted to highlight a couple of our guiding values because I think last year tested those, and two in particular. So relationship and service. And once again, we had to adapt our service model to what was really needed during that time, which was open and consistent communication. So we are dedicated to having constant and open communication channels, and hopefully you saw that throughout last year. And then relationship, it's really a two-way street, and we thank you not only for your confidence you place in us, but for your words of encouragement during some of the tough times we faced last year. We really appreciate that, and I have some of the best relationships I can imagine. Well, when I left engineering about 30 years ago and got into the financial planning world, I told someone I wanted to work in a field where I could constantly learn, and little did I know 30 years later that would be more true than ever. Last year was just full of extraordinary challenges, and for all of us, it's really changed us, the way we do business, the way we connect. And so really this is about looking forward. We'll cover some of what happened last year, but I'll finish with ideas for investing and things we're implementing now for stocks and bonds. But it's, I think of it as a time to restart the engines, and everything's going to look and feel a little bit different than last year. So as you recall, the economy was improving nicely during the early part of 2020, and then really going into 2020, we had a slight slowdown in the end of 2019, but it was really that March timeframe when everything skidded to a stop because of COVID-19, and the pandemic ended the longest bull run in history, more than 10 years. And that was caused by the government rules, closing businesses, people staying home, all in response to the virus. And then as we dug ourselves out, it was later in the year, probably we'll look at a new economic expansion that began and how long it will last. We'll have some statistics on recovery later. But really, again, one of the more difficult years we've experienced. Pandemic, a deep recession, a bear market. And yet, this is looking at the stock market, ended on a high note. So as my good friend Alan Greenspan used to say, after Black Monday in 1987 and the market rebounded by the end of the year, he said, it was then that I realized how resilient the financial markets are. And we learned that lesson over and over again. Although when we're in the middle of it, it doesn't seem like it sometimes. In terms of volatility, the stock market had one of its worst peak to trough declines in the past 40 years. You'll see, a 34% drop in the middle of the year, and yet we ended up. So the recovery was quite rapid and really once again rewarded the disciplined investor that didn't see that and panic. But difficult to do during times like that. Now, when we say the stock market, we were measuring that based on the S&P 500, so the 500 largest companies. But really it was quite diverse depending on which industries benefited and which were negatively impacted by all the events of last year. And so you'll see online retail, really Amazon, and information technology, all the technology companies adapted. And of course, we put a lot of emphasis, all as individuals, staying home on those particular segments. What got really hurt was leisure industries, hotels, resorts, cruise lines, airlines, and with that, the energy sector as well, which had some other challenges of just an overabundance of oil on the market. But you'll see, from a minus 34% return to a plus 69% return, it really depended on where you were invested in particular industries. And the other part to look at is this is the weight of the top 10 stocks in the S&P 500. So out of 500 stocks, the top 10 in terms of market size represents more than a quarter of the total market cap of the index. And those are the big names, Apple, Microsoft, Amazon, Google, all worth over $1 trillion each, driving whatever the market returns. So whatever happened with those companies, and they're all technology companies, we saw outsized returns, and really that led the index. Now, when we're looking at PE ratio as a measure of either value of stocks or what has to happen in terms of growth for those particular companies, those are outsized at this point. So either earnings have to keep up and continue to grow dramatically, or there's some downside to those stocks, or they may just sit still for a while until growth catches up to them. But we just want to highlight that as watch the concentration in your portfolio so we don't get stuck with 10 big companies either driving your returns or exacerbating your losses. Now, the other big news in terms of economics is interest rates falling again. We had a period of time here where we were seeing them go up for a couple of years. And I guess if the less negative news is that the US is one of the few countries that haven't issued what's called negative yielding debt, where the lender actually pays the borrower interest, in reverse of what's normally done. And there's $18 trillion in negative yielding debt out there. But it's all outside the US. And what that means is that foreign investors and governments want to invest in our treasury bills. They make more money on it. So, both from a demand standpoint, really, LPL is forecasting a modest rise in the 10-year treasury yield up from currently it's right about 1.1%. And they think we'll finish the year about 1.25 to 1.75, somewhere in that range. So positive side of low interest rates is that it's great for business stimulus, a lot of borrowing, great for homeowners if they want to refinance. The negative side is really that it's tough for investors that are relying on fixed income to pay the bills. It's going to be hard to get some sort of a good interest rate on virtually anything in the fixed income area. So let's look at 2021 going forward. Where do we go from here? And one of the first big changes should be getting back to some normalcy in terms of socialization, work, travel, and with that, the consumer representing 2/3 of the economy in terms of spending, should get out there and spend more. We've seen a lot of our clients saving more this last year because there was really virtually no place to spend their money. And of course, we have a new Congress, new president, and I don't put a lot of emphasis on this. The statistics say that a democratically controlled Congress and not a split Congress is the worst in terms of stock market performance. But in truth, it's interesting, but not really meaningful. I think this is better left for cocktail party debates. That there's so much more to the economy than just who's in power. Of course, everybody's watching the COVID situation. And we can look across the U.S., but of course it's very localized as well. But the number of COVID cases is expected to decline, and the vaccine rollouts, should pick up pace. And when it starts protecting our most vulnerable citizens, that's going to be a good sign that the economy can pop back. As I said, interest rates are low, and the big thing is that the Fed is forecasting that they're going to keep those rates low for at least a couple of years. Very significant in terms of where we invest in terms of fixed income, and I'll have some thoughts on that later. But historically low. This chart, rather busy, but volatility we measure by a certain index called the VIX. Spiked up, of course, back in March and been relatively declining since then. And really that's the highlight, is that we expect volatility in the stock market to continue to dampen as the economic uncertainty declines. So as businesses begin to improve, if we have less policy changes, that's all a good sign for stock markets, as markets just don't really like that uncertainty. And of course, neither do us individuals. And also that corporate profits are continuing to increase, and that's really the consensus of most economists and LPL's research as well. And that's bodes well for the stock market. So even though by some measures the stock market is a bit overvalued at this point in terms of historical averages, we've got a race to grow into that. And once an economic expansion starts, of course, it runs for a while. How long is anybody's guess, but the average is about 5 years. As I said, we had just had the longest in history, over a decade. So let's see where we go from here. Right now, that expansion is only a few months old, but we've got both monetary and fiscal stimulus happening, with a vaccine, coming online. We can anticipate, at least a few years of growth. And so, it's only history will tell us whether we hit that average or more in the future. And with that rebound, we're looking at forecasting a rebound in earnings for the big companies. Also bodes well for small companies and mid-cap companies. So we have moved some money there. But earnings growth of 25% for next year is pretty substantial. And looking even beyond that is, picking up momentum. So here's LPL's forecast. For the United States, we're looking at growth in the area of 4 to 4.5%. and globally large companies a little bit more than that. And then emerging markets, which includes China and other smaller economies, possibly, you know, exceeding that by 1% or so. Inflation, we think, will remain in check, at least for the near term, and unemployment dropping again substantially as more and more get back to work and get off part-time work as well. So all good news, which, you know, then they forecast a growth in the stock market based on, you know, earnings growth. And I said Treasury yield remaining relatively flat, but maybe slightly up. And really, once we start a bull market, same thing as growth in the economy, it typically lasts more than a year. So we see this is the blue is the first year average, and the orange is a year after that, so 2-year run. So it just means keep your eye, you know, focused on the long term. Don't think that, you know, the rebound happened and that's it. We think it'll continue to run from here. So let's turn our focus to bonds. And, you know, the majority of our clients are at or near or in retirement. And so a lot of their portfolio is in fixed income and bonds. And it's actually a bigger market than the stock market. And it just seems to be less interesting for most people, but it's actually way more complex. So we think there's opportunity in the bond market, but with low interest rates, it's going to be difficult to make, you know, the types of returns we saw over the last few years. And typically, like most markets, there's a rebound. So this is also why we think rates will come back up slightly. As business improves, there'll be more incentive to increase interest rates. But the main reason we use bonds is sort of the ballast in the portfolio. And so I'll just highlight here, these are particularly periods of time when the S&P 500, the stock market, declined by more than 10%. And you'll see the periods here, 10, 15, even 33% last year. And then what happened with the total return on bonds. So Barclays Aggregate is a particular bond index, doesn't represent everything. But really almost, you know, no loss during periods of time when the stock market was really heavily impacted. And you'll see treasuries, and especially last year was a particularly good time for treasury bills, had positive performance. So that's really why we use them, is for a ballast in there and make sure that we have some protection in terms of declines in equity markets. Oops. And this slide is, I know, very busy. You probably can't see it well on your monitor at home, but it's simply pointing out different types of fixed income and that they all rotate in terms of performance over time. So last year, what led the way was TIPS, or Treasury Inflation Protected Securities. So, you know, up 11%, corporate bonds up almost 10, treasuries 8. And what's at the bottom is emerging market debt. But those things rotate, and the main thing is to maintain a diversified portfolio in your bond portfolio, just like you do in your stocks. And then look for, you know, what particular areas we think are valued properly or don't have a high risk to return profile. So just because TIPS were up last year doesn't mean we want to be in them this year. So we really both look at a diversified set of bonds, and then, you know, which types of debt we want to be in. And I think it's on here. No, these are alternatives. So other things like preferred stocks, which we've invested in this last year, give us a nice yield of, right now we're about 4.5%. but they also have an underlying component of a stock. So they could go up in value or down in value like a stock. So it has a different set of profiles, but another way to get income. Or things like real estate investment trusts tend to produce a nice steady income, and again have a longer market cycle than a stock market, just being real estate. So, we are looking for alternatives. Where do we get income from when we're in such a low yield environment? We don't just stick to a bond portfolio. So some tips, what do we want to do right now in the near term? And I like this little cartoon here is, he's socially distanced, but he's also very distant from his 401k. I can't see my 401k balance from here. And the other fellow says, well, that's the idea. There is a part in investing is how often do we look at our portfolios and when? And so, we mandate an annual review, but some of our clients like quarterly, some half year. But the idea of looking at it, daily and trying to react to it is really a wrong discipline for an investor. So yeah, you don't want to be so far away that you don't know what's happening, but really set those time frames and be disciplined about looking at it and tuning it up over time. So where are we in terms of bond investing? This blue line represents today's yield curve on the Treasury bills. And you'll see when we talk about a 10-year, this one says 0.93, it's slightly higher than that right now. But the difficulty is if we start going longer and longer and say, I get a 30-year bond at 1.6, well, don't I get paid more? Why don't I want to do that? Because the risk on this is actually greater or about the same or greater than the stock market. When interest rates go up, you're going to see these bond prices come down and rather dramatically. And so that's our difficulty is where do we invest for a reasonable return in the fixed income? And you would see these similar types of curves, whether it was for corporate bonds or muni bonds. So somewhere right now our sweet spot is in this 3 to 7 year type of time frame, what we call intermediate bonds, or even short-term bonds. So we give up some return, but for the relative safety that someday when interest rates go up, we're not going to lose money. And as I said, we like muni bonds right now. LPL's very bullish on the mortgage bond market being a relatively stable market and not seeing a major housing crisis coming. We can count on income from there. And corporate bonds, but really high quality. The thing is to look at high quality right now. Don't be caught with a high risk bond portfolio. And as I mentioned, overall the S&P 500, has a relatively high valuation for history. So just really watch for diversification within your stock portfolio, and be prepared for some downside, or for the portfolio just to sit still as things catch up. Now, just as I mentioned, all these different segments of the market having different returns, we also can group stocks, US stocks by style, which we call value or growth, or small to large. And what I wanted to point out here is the large growth companies have the highest PEs ratios. And so what we've done is moved some money to value stocks, basically that segment being a kind of a laggard in the market and expecting it to catch up. And again, to some small companies. So, not just relying on large US companies as the dividend payers. They've been great, but those growth companies have kind of gotten ahead of everything. And then we've also moved more to the international markets, and for our growth portfolios is adding some emerging market equities as well. And the reason being that, as you saw, we expect growth to be better in those areas. And at the same time, the valuation measures say they're cheaper than US stocks. So probably less downside risk and more potential for growth, which is a great combination. So that's our emphasis, is in both of those areas. And then lastly, a couple slides, which you've probably seen before, but again, diversification, discipline, always rewards, the investor. So this is just showing that we've got different types of investments. Virtually every portfolio is built on all these different segments. It's not purely stocks and bonds. It's various segments of bonds and various segments of stocks, and designing those portfolios to, continue to be an all-weather type of portfolio, and that time limits risk. So, yes, we typically will talk about 1-year performance, but all of us have timeframes of 5 and 10 years or more where we want to accomplish our goals. And, eventually that volatility dampens down, and we can count on those returns over longer periods of time. So really trying to match that up to your financial planning goals, and having the appropriate mix of investments is just the right type of planning to do. And that's really all I have for today. Shannon, if there's any questions that came in, you could probably take a couple of those.
Yeah, there's a couple. Just a reminder, we're moving into the Q&A segment now. If you do have any questions, email them to me at shannon@kingwealth.com. Also, please take a moment at the end of the webinar to complete a brief survey so we can keep these types of offerings relevant and meeting your expectations. Okay, first question is, what are your thoughts on what was going on with the GameStop stock?
Yes, GameStop. So, highlighted a number of things in the market as actually a fascinating kind of story, because we all know hedge funds exist, but we don't really know what they do, and all of them have different strategies. But one of the strategies is selling stock short. So, borrowing stock from someone, selling it with the promise that you'll buy it back and give it back to them someday. And they do that on companies they expect to go down in value or go out of business. And GameStop is one of those, closing all their stores. And it also puts pressure on the company because you're basically pushing the price down. Well, along comes these online investors who see what's happening. And one of the big things that highlighted to me, which I hadn't heard before, was that these short sellers had shorted more than the stock existed. There was 140% of the shares were shorted. And how that's even possible, I don't know. But this is what these online investors saw and said, well, we're just going to push the price the other way. So it became a very tug of war, and caused a lot of volatility. Now, is that good for the average investor? No. We would like some idea of what a company's worth day to day, but it does highlight the forces out there that can exist. And in the end, the stock market is made up of information. It's just all of what we know, and a price is all the known information on a given day. So having better information flow would be helpful, and there's a push to make hedge funds more transparent so that we can understand that they've shorted 140% of the stock. So that, I think that you'll see a lot of talk around it, especially with the regulators saying, what do we need to do to control this type of behavior on both sides, and make the stock market a little more friendly to us that are trying to actually use it as an investment rather than a gamble.
Sorry. What is the outlook for the real estate market?
So real estate is, again, another complex environment. So when we're talking about the real estate market, I know a lot of the attendees here are here in California, but there's some on the East Coast. And so, you know, as a housing market, we think it's quite good. The interest rates have come down. We've seen a lot of refinancing. We see a lot of buying activity. So we don't see any real problems there. But at the commercial markets, it depends. Office market was hit because there was just less demand during this whole COVID thing. Whether that returns to normal, or we've had such a long period of time that people say, well, working remote works fine. We'll have to see. But there are certain segments of the commercial market that operated quite well, and you know, were benefactors of especially the online retail story, and having you know, warehouses that store things and really help with logistics of all this shipping that was going on. So I think it's, you know, it's a market that you have to look at which particular segment you want to be in, if you're an investor in that area. And everyone take a look at your interest rate on your current mortgage, because we hear rates down around 2%. It's pretty amazing.
Okay, that looks like that's the last of what came in. So I guess that's a wrap. Thank you all for participating. Thanks, Paul, for bringing this valuable information to all of us. We wish everyone a wonderful day and a wonderful week. We'll see you at the next one.
Thank you, everyone.